So in our last class, we were discussing our company's income tax, and I remember we discussed about a lot of things in our last class. One of the things we discussed about is the filing of tax returns. We discussed penalty for failure to file returns. We discussed significant economic presence. We discussed filing by non-residents. So, and we also discussed the content of returns. We discussed the content of returns. I know you guys have the material. So, I'm going to continue from where we stopped, actually. I'm trying to open it. So follow me to page 8. Let's discuss book of accounts. Books of accounts. Are you there with me? Now, what's the act saying? The act is saying that every company, including those granted exemption from filing, must keep a book of accounts, must maintain a record that is sufficient, must maintain a record sufficient with required complaints information. Now, what is the essence of this? The essence of this is that for tax authority, they want to have your record at times. And if you don't have adequate record, it's going to affect them in doing their work. Therefore, so they say you must maintain books of accounts, and this book of accounts must be maintained in English language. In English language. This is section 63 of the Act. So you must maintain it in English language, and where this book of accounts is not maintained in English language, must be transcribed or translated and signed or certified by a sworn translator. So what we're trying to say here is that at every point in time, maintain this book of accounts in English language. And once it is maintained in English language, it's fine. But in a situation where the book of account is not kept in English language, then there must be translation of whatsoever that you have. You must translate it. Okay? So that is what we are trying to say. Such must be translated. Now, if the book of accounts is not kept properly, or the government requests for the book of accounts, and unfortunately the taxpayer is unable to present the book of accounts, there is penalty. Penalty for failure to keep penalty for failure to keep books of accounts. What are the penalty? In the first month in which the failure occur, penalty for failure to keep proper book of accounts. One, first month of failure. The taxpayer shall be liable a penalty of 100,000. Two, every subsequent month. Every subsequent month. In which the failure continues. The taxpayer shall be liable for a penalty of 50,000 going forward, of 50,000. So what we're trying to say here is that when a taxpayer fails to maintain a proper books of accounts, the taxpayer in the first month of default will be required to pay 100,000. Subsequently, he will be paying 50,000. Now, the book of accounts must be maintained. The book of accounts must be maintained for at least 6 years. Maintained for at least what? 6 years before you can say you don't have it again, which is 6 years after the year of assessment. Maintained for at least 6 years after the years of assessments. Okay, so that is that. Do you have any question? Before we go ahead, let's quickly talk about type of companies that we have according to Finance Act. Types of companies. Types of companies. Basically, we have three types of company according to Finance Act, which is the small company, the medium-sized company, and the large-sized company. If you are with me, I'm currently on page 11. We'll still go back to page 9, but let's talk about page 11. Now, what do we mean by a small company? A small company is a company with a turnover that is less than 25 million. Less than or equal to 25 million, less than or equal to 25 million. So most importantly, what is very key here is that the company's turnover is what is used in determination of the company's size. Whether the company is a large company or the company is a small company, the determinant is the turnover of the company. A company is a medium-sized company where the turnover is greater than 25 million but less than 100 million. So we say the company is a medium-sized company. For a large-sized company, a company is large size where the turnover is greater than 100 million. Yeah. Now, according to Finance Act, where a company is a small company, the company will not pay tax. Therefore, tax liability shall be zero. Where the company is medium size, the tax liability will be 20%. Where the company is large size company, the tax liability is 10%. Now, for these companies, there are implications as to payment of tax. So another thing that we also need to talk about is what is a bonus for early payment of tax liabilities. This is going to be judged by size. So if a company pays its tax liability within 90 days after the accounting year, such a company is entitled to a bonus. Now, again, depending on the size of the company, where the company is small business, bonus. Where the company is medium size, bonus is 2% of the tax paid. Where the company is large size, 1% of the tax paid shall be given as bonus. Now, how do these companies take this bonus? How do they utilize it? Utilization of the bonus. Utilization of the bonus. The bonus shall be utilized in the subsequent tax year. Do you understand me? So, take for example, if a company pays its tax liability as I went due within 30 days for 2024 year of assessment. Okay. So when the company wants to pay 2025 year of assessment tax, okay, by implication, you know that this is going to be 2023 year end, Abby, and this is going to be 2024 year end, Abby. Abby now. Hello. Hello.
Yes, we are with you.
Yes,
we are with you, sir.
Yes, sir.
Okay. So what we are trying to say here is that this company, before they can take advantage of that bonus for this year, because they paid early, ordinarily they are supposed to pay. The act says pay within how many months? Within 6 months. But the company, because they want to take advantage of this bonus, they now paid within 3 months, which is 90 days. Then, depending on the company, we said if the company is medium size, 2%. If it is large size, 1%. So this benefit, you can only take advantage of that in the subsequent tax year. So that means in this year, if your tax liability is 100,000, if you are small, medium size, 2% of that is 2,000. This 2,000 will not be taken this year. Next year, you now want to pay your tax liability. What you would imagine the tax liability that you're supposed to pay that year is 103,000. So the previous period liability, which is 2,000, you remove it to have your current period tax liability. Do you understand? So that is what we are trying to say. Any question? In the absence of no question, let's go back to our computation of tax liability. Now, payment of tax liability. Payment of company tax. Hope you guys still go back to view this class after we are done. So always do that. It's very important to revise what we have done. So basically, tax liability can be paid in 4 ways. The first one is CIT on dividend. The next one is CIT on total profit. The next one is CIT on turnover. The next one is minimum. Let's take it one after the other. I'll take the first one, which is CIT on dividend. CIT on dividend. So for now, before 2019 Finance Act, Section 19 of Company Income Tax Act is dividend shall be assessed with tax where the following occurs. One, where there is no total profit. Two, there is total profit, but the total profit is less than dividend. So what the act says then is less than dividend. But what the act says then is that if these two situations occur, that is number one, there is no total profit, that is the company did not make profit, but goes ahead to declare dividend, or the company makes profit, but the profit compared to dividend is less. Therefore, tax shall be assessed on the dividend at the rate of 30%. So in that scenario, I am saying if your total profit, for example, is 100,000, but you declared dividend of, let's say, 150,000. Now, scenario number 2 is what is playing out here. There is total profit, but the total profit is less than dividend. Therefore, the tax authority shall subject the taxpayers with tax on the dividend. That is what the law says. Therefore, my tax liability shall be 150 million multiplied by 30%. That will be 45,000. Ordinarily, the company before now would have paid tax liability on total profits, which is 100,000 multiplied by 30%. We would have paid 30,000. So what we are trying to say here is that additional tax liability that this guy will pay, 10 million. That was the position of the act. Do you have any question?
No,
That was
sir,
the question.
can you
Yeah.
go again? I didn't quite understand.
Okay. I was saying the position of the act before now was that where a company declare dividend and the company says there is no total profit, or there is total profit, but the total profit is less than dividend declared, then the company shall be subject to tax on dividend. And I'll give you scenario. I said scenario one. Assume the company's total profit is 100,000 and the dividend is what? Is 150,000. So what we are trying to say here is that scenario 3 is playing out. Scenario 3 is playing out here. And in scenario 2, we are saying that the tax liability of this company will be based on dividend. Why? Why would it be based on dividend? It will be based on dividend because the company declared a dividend that is more than your total profits. Therefore, the tax liability shall be on the dividend, not on the total profit. But before now, the company doing its cunning way would have gone ahead to pay tax liability on this 30,000 or 30 on this 100 million. I mean, so doing that would have meant that they would pay 30,000 as their tax liability. However, the Act says that where the total dividend is more than the profit, then you subject the tax, company tax on their dividend. Therefore, we are doing that exactly, subjecting the company tax on the dividend. Okay, so that is what we're trying to do. I can see that this class is having some new students in class today that I don't know. Ogene Tega, are you joining us for the first time? I'm seeing for the first time. Tega. Okay, Sade, I am also seeing you for the first time in this class. Ifeoma, I'm seeing you for the first time in this class. Olumide, I am seeing you for the first time in this class. Introduce yourself.
Yeah, good morning, sir. So I joined last year. I was previously for physical, but I had to switch to online because of work demands. So
Okay. All right, Olumide.
Morning, sir. It's not my first time. I've been here for like maybe 3 or 4 weeks now. So, yes, I was in physical before. I swapped to online. So, thank you, sir.
Okay. Did you get permission to switch to online?
Of course, I can't do it on my own. Of course.
Okay. Tega. Is it that Tega is not in this class?
Yes, good morning.
Good morning.
Good
How
morning,
are
can
you?
you hear me?
Yes, we can hear you.
I'm saying thank you.
Okay. Siri, mute your phone. Tega, introduce yourself.
I've been at this class, sir.
You said?
Oh, hello?
Yes.
I said I've been attending the class.
Okay. No issues. All right. What about Oruma, Ufoma? Introduce yourself, please. I don't know you.
Hello, good morning.
Morning, Ufoma. Is this your first time?
I've been joining your class. No, sir.
Okay. The implication of
It's
this
not my
that
first time.
I have not been giving you assignments, and that's why I've not known any one of you like that. But I know some of you. I know KG. I know Omomi, I know Ibikunle, I know Esok, I know Siri, I know a lot of you, I know Obed, I know Norma, I know Kelvin. So I know a lot of you. Where is Mr. Wellington?
Even me,
In
you
class.
know me very well, sir, only because I'm not in physical now.
Okay. So where is Mr. Wellington? He's not in class today. Okay. And Alaji too. Alaji Sani is not in class today. Okay. So go ahead. All right. So, as I was saying, I said this was the position of the Act before 2019 Finance Act. So, in 2019 Finance Act, what happened? That now says, even though these two conditions exist, where it can be established, so exemption, so dividend tax, number one. So the act says where this can be established that the dividend was from retained earnings. Such shall be exempted. Shall be exempted from tax. So if the dividend that we are talking about here was from retained earnings, it shall be what? Exempted from tax. That's number one. Number two, if the dividend is from profits already exempted from tax, number one. Number two now, this is number one. Number two, where the dividend is paid out of profits already exempted by the provisions of CGT, PPTA, and pioneer legislation. Such would also be what? Exempted from tax. So what we are trying to say here is that there are some dividend exempted from tax. So if, for example, this is a situation that occurred, during pioneer legislation, within the first 5 years, within the first 3 years, companies are not expected to pay tax on their income for pioneer legislation. So, and if companies are not expected to pay tax, if they're not expected to pay tax, and the Act under pioneer legislation also states that any dividend declared during the pioneer status shall be exempted from tax. So if peradventure the company declares dividend during that period, such dividend shall be exempted from tax. That's what we are trying to say. So we are now saying that this dividend will not be subject to tax because there is already a provision in other tax law that exempted dividend from tax. Do you understand me? That is it. Number next. 3. Number 3, where the dividend is paid from frank investment income. We all know what frank investment income is. Frank investment income is the income that is not subject to tax because it has been withholding tax has been deducted at source, and such will not be subject to further tax liability. An example, the only example of frank investment income is dividend. Okay, the income has been subjected to tax at source, and therefore such income will not be subject to further tax liability. And the only example of that is dividend. So dividend will be exempted from tax. So even if the dividend is paid and is from frank investments, then we are saying that such will not be what? Subject to tax. Number 4.
Hello, sir. Good morning.
Good morning.
Sorry, my network threw me out for where you were explaining number 1 and number 2. I don't know if you can help me go over it again. I'm so sorry for taking us back.
What is your name?
Mercy.
Mercy. How are you?
I'm fine, sir.
I did not greet you this morning.
I'm fine, thank you.
So sorry about that. Our backup girl. I've gone to look at your Facebook profile and I saw you went to backup. Okay. All right, let's go ahead. So retained earnings, okay, we are saying that where the dividend is from retained earnings, okay, such a dividend would be exempted from tax. Okay, so that means, when you are doing your SFA, your lecturer must have told you something, that profits, it is either you distribute when you are doing dividend policy. I don't know, maybe they have taught you dividend policy. Under your dividend policy, it is either you distribute, that is, give dividend to your shareholders, or you retain your profits for the expansion of the business. So the company at every point in time is always faced with the challenge of whether to retain their profits or to distribute the profits. It is a big challenge that is being faced by companies. So we are now saying that there could be a situation where companies pays dividend. A situation where a company does not make profits in a particular year, but still goes ahead and pay dividend. That means a company that did not make profits is not entitled to pay dividend. Abi? But the company goes ahead and pay dividend. That means the dividend must have been paid from somewhere, which is retained earnings. They made loss, but the company went ahead and paid dividend. That means that dividend is not from their profits. It was paid from their retained earnings. Because the profit was paid from their retained earnings, then the profits, the dividend will be exempted from tax. Do you understand me? We said number 2. The Act already provided that there are some income that are exempted from tax. There are some income exempted from tax. There are some dividend that are exempted from tax, such as during the tax holiday of a pioneer company, their tax is exempted. So they don't pay tax. Therefore, any dividend declared during those periods too will not be subject to tax. Under capital gains tax, there are some gains or dividend exempted from tax. So all these things are stated clearly. So we're now saying that this will not also be subject to tax because the Act already made provision for that. that they are exempted. So don't go and be subjecting them to tax again. So number 3 is frank investment income. I was explaining that frank investment income is the income that has already subjected to tax at source, and therefore should not be whatsoever the additional tax liability. So that is that. The next one is any income from real estate investment company. Any income, any dividend rather. Any dividend, that's number 4. Any dividend from real estate investment company shall be exempted from tax, provided from tax, provided 1, at least 75% of such income is redistributed to the shareholders. So this must be done within 365 days, in which the income is distributed. So this is what the act says. Okay. So if that is the case, if the dividend is from real estate investment company to a shareholder, okay, then the income shall be exempted from tax liability. The dividend shall be exempted from tax liability. The dividend shall be what? Exempted from tax liability. Do you have any question? And at least 75% of such must be redistributed to the shareholders. Okay, let's go back to our study pack. In our study pack, we have some illustration that we need to discuss. To page 9 in the study pack. Okay, so let us read. Illustration 1. Who's reading for us? Come on, read for us.
Okay. Let's see. Okay, an extract from the financial statement of Retention Policy Limited for 2021 shows the following. So we have loss for the year 1.5 million, retained earnings brought forward 11 million, dividend declared for 2021, paid in 2022 1.5 million. From the above illustration,
Pause. So when you look at the explanation I gave you the other time, I said, number 1, under section 19 of CETA, I said where the company makes loss or there is no total profit, the company shall be subject to tax on the what? On the dividend, Abi. 2, there is total profit, but the total profit is less than dividend declared. The company will be subject to tax on dividend. In the 2 situations, we said the company shall be subject to tax on dividend. But we now said further, ordinarily, if this were to be before 2019, I would have gone ahead and subject this company to tax on dividend. Abi? Why? Because when you look at the provision of Section 19, the provision says where there is no total profits, Abi, subject the company to tax on its dividend. Or there is total profit, but total profit is less than dividend. In this scenario number 1, where there is no total profit would work because this company makes no total profit and declare dividend. So the dividend will be subject to tax according to Section 19 before Finance Act 2019. But with effect from Finance Act 2019, then there is now exemption to these 2. So the exemption now further says that if the dividend is paid from retained earnings, then the dividend shall be exempted from tax. Now, I will put it to you guys that this company that made loss of 1.5 million and goes ahead to declare 11 million. Sorry, as a retained earnings of 11 million, as a loss of this, and declares 1.5 million as dividend. Where did this guy see the 1.5 million that he declared? Where did he see it? Where did the company say the 1.5 million declared? Where? Who is that?
From retained earnings.
From retained earnings. Therefore, this 1.5 million shall be exempted from tax because there is no way this company would have declared dividend without dipping their hand into their retained earnings. So the dividend was paid from retained earnings. Therefore, it is exempted from tax. Do you understand? Do you understand me?
Yes, sir.
Yes.
Yes.
Yes, I understood.
Good. Let's go to the next one. Number next. Will we help us out?
Can I continue?
Yes.
Okay. So from the above illustration, 1,500,000 dividend was paid. Paid will be exempted from the application of Section 19 sub 1 because it is reasonably clear that the dividend was paid out of the company's retained earnings for the previous year.
Illustration 2.
Okay, illustration 2. An extract from the financial statement of MKO Nigeria Limited for 2021 shows the following. Profit for the year, 11 million naira. Retained earnings brought forward, 20 million naira. Dividend declared for 2021, paid in 2022, 15 million naira.
Pause,
From the
don't
above,
read the, no, don't read that one. So let's analyze this. So don't go and be reading the explanation. Let's focus on this. The company made a profit of what? 11 million, right? As a retained earnings of 20 million and declared dividend of 15 million. It is clear when you look at this vividly that the dividend that this company paid was paid from two tranches. One, the dividend was paid from profits, which is 11 million, and the balance, which is 4 million, was paid from retained earnings. Therefore, the dividend exempted now from tax shall be 4 million. Why? Because the 4 million was paid from retained earnings. The 4 million was paid from retained earnings. You understand? So let's look at the next one, which is the last one, illustration 3.
Okay, illustration 3. An extract from the financial statements of ADV Nigeria Limited for 2021 shows the following. Profit for the year, 52 million naira. Retained earnings brought forward, 105 million naira. Dividend declared for 2021, paid in 2022, 42 million naira.
So if you look at this, who will explain what would happen here? Who would explain what has happened here?
So the dividend declared for 2021, 42 million. All of it was paid from the profit for the year, so it will be subject to tax.
Good. That's the meaning. Everything was paid from what? Profits. And therefore, everything will be subject to tax. So it is invariably, it's just the same thing to say that the profit of the year is subject to tax. So that is that. Because the profit, the dividend, was paid from profits, not from retained earnings. So that is that. Let's go to the next one. The next one is CIT on total profit. Basically, before now, you guys have done trading profit and loss adjustments. Abi? So when we're talking about CIT on total profit, we are saying the profit the company derived in a particular year is subject to tax on the total profit. So how do we identify the total profit? Before now, we have done adjusted profit. Abi? In our adjusted profit, we have discussed what is allowable expenses and non-allowable expenses. All those had been discussed. We have also discussed the tax implication of taxable income and non-taxable income. Before today, we have discussed loss relief And we have also discussed balancing charge. So, balancing charge will come in. We have loss relief that we have discussed before. Loss brought forward, loss for the year, loss relief for the year, and loss carry forward. The enemy. After that, we go straight to our capital allowance. You remember, we said capital allowance is an allowance granted to a taxpayer that has incurred qualifying capital expenditure and put same to production use at the end of the basis period. So, we would also remove our capital allowance. Capital allowance for the year. Relief for the year. If it is trading organization, we restrict it to 2/3 of the accessible profits. If it is manufacturing, this is trading. Manufacturing, no restriction. Grant 100%. Carry forward. So, what we're trying to say here is that to get your total profits, it is the addition of all your income that you have here, that is accessible income plus balancing charge, less loss relief, less balance, less capital allowance to get your total profits. Now, on the total profit, you would compute your company income tax at 30%. Remember that if the company is small size, 0%, medium size, 20%, large size, 30%. Put that in mind. So for a small size, you don't need to do anything. Tertiary education tax. If it is 2023, it's 2.5%. 2024 is 3%. Examiner will always give you the rates, so you do not need to cram it. It's just the application of the rates that you need. Okay? It's just the application of the rates we need. Trying to see a past question. So the examiner will give you the rate anyways. So do not cram anyways. Just like I've told you, this aspect is almost like someone that wants to do corporate reporting and do not understand group accounts. It's just the same. This part is always number one in your exam. Company income tax is number one. And that's why I'm taking my time to teach it. It's 30 marks with all the theories. So they are very important. Okay. So that is that. We'll leave that and we'll come back to that later. Number 3. CIT CIT based on turnover. Now, how does this affect CIT? For this, we will say companies should be assessed with tax on their turnover where the following occurs. Number one, where the companies there is no accessible profit. Where there is no accessible profit. Number 2, there is accessible profit, but the accessible profit is less than expected. Are you with me? Number 1, there is no accessible profit. Number 2, the accessible profit is less than expected compared to the industry the taxpayer operates. Okay, so we are saying the accessible profit is less than expected, or there is no accessible profit. In 2021 Finance Act, a company that operates a significant economic presence in Nigeria shall also be assessed to tax liability on its turnover where there is no accessible profit there is accessible profit, but it is less than expected. Number one, there is no accessible profit. Number two, the accessible profit is less than expected. Okay, so what is the basis? The Act provides that the taxpayer shall be assessed for tax on a fair proportion of its turnover. Underline the fair proportion. That's based for computation. So again, the fair proportion is subjective, as there are many taxpayers that are taking the government to court on assessing them the tax on their turnover. Turnover assessment is also an anti-tax avoidance measure, where a taxpayer just wake up and tells the government that I do not make profit, or the profit the government is expecting from the taxpayer is less than expected. Therefore, such a company will be subject to tax on the fair proportion of its turnover. Any question? Any question?
Yes, sir. So when we say there is the accessible, the profit is less than expected, is it the taxpayer that expectation who determines how much is expected?
Who determines it? It's the tax authority, because they have seen what is happening in the industry. Okay, so they know that the tax authority is supposed to, the taxpayer, they know the range of tax liability the taxpayer is supposed to pay. So if he's not paying less, or he's saying that there's no profits, then the tax authority is put on an inquiry to check and assess the taxpayer the tax appropriately.
Okay, thank you.
Any question? Any question? So that is turnover assessment. Okay. The next one is minimum tax liability. When does minimum tax occur? A company that has made loss will definitely not pay tax. Abi, where a company makes loss, the company is not expected to pay tax. Abi, therefore, the tax authority does not want to leave any stone unturned, and that was one of the reasons for the introduction of minimum tax. Why, where, or how does minimum tax occur? Number one, where the taxpayer where the taxpayer has no total profits. Number 2, the company income tax liability is the company income tax liability is less than minimum tax computed. You understand? So you have computed your company income tax. You got 15 million. You computed your company income tax. This minimum tax. You got 1.5. Which one will the tax authority take? Would they take 1.5 or they will take 3.5?
They will take minimum tax.
They will take the minimum tax. Why? Because the minimum tax is giving us the higher profit, higher tax liability rather. And because it has given higher tax liability, the tax authority would always take one that will give them the higher tax liability. Okay? That's that. Number 3, the accessible profit results into no tax payable. Okay? So the accessible profit results into no tax payable. What do we mean by that? We are saying that the profits results into no tax payable. What are we saying? Imagine the profit of this company is majorly from profit exempted from tax. Example, profit on disposal of assets, dividend, treasury bills. All these are exempted from tax. Let's now say that is the profit the company made that year. That means the profit will result into no tax payable. Abi? So minimum tax shall be computed. Now, what are the companies exempted from minimum tax? Hope you are jotting down. Companies exempted. Exempted companies. Minimum tax. 1. Companies that is not up to 4 years in business. Companies in its first 4 years. Number 2. Agricultural businesses are exempted from minimum tax. Number 3. Companies with a turnover of 25 million and below, they are exempted from minimum tax. Okay? All these things that we are doing, examiner usually asks them. So you have to take note of all this. Examiner usually asks them. Okay? How do you compute minimum tax? Minimum.
Hello, sir.
Yes.
Hello, so please can you come again with this explanation of the minimum tax? I'm not getting it very well from that profit side.
You mean here? We said where the profit of the company results into no tax payable. Are you getting me? The profit of the company results into no tax payable. What that means is that they have profits that they have made, but they will not pay tax because the profit is already exempted from tax. And I'll give you an example. Profit on disposal of fixed assets is not allowed, it's not taxable. Dividend not taxable. Treasury bill not taxable. That means the company will not pay tax. So to avoid non payment of tax, then minimum tax was introduced. Okay. The next one. The next one. How do you compute minimum tax? Minimum tax is computed on turnover of the company less frank investment income. Minimum tax is computed on turnover less frank investment income. We are using time to do minimum tax as a topic. So follow me carefully. So what is minimum tax? How is it computed? Minimum tax is computed at rate of 0.5% of the profit. How are you? Can I call you back when I'm done with my class? Okay. Go ahead. Okay, I'll call you back when I'm done with my class. I will explain to you. We'll do video, okay? I'll be done by 10. That means 15 minutes time. All right, baby. We can do Zoom class. I will teach you on Zoom. I will do a Zoom class. You have Zoom now. There is Zoom in that your tab. Download the Zoom. Once you download, it will prompt me. I will give you access. Oh yeah, go ahead. Yeah. Hello, guys. Hello.
Yes, sir, we are here.
Yes, sir, we are here.
So sorry. My son called me. He's not been around, so he needed my help. Just like I'm helping you now. So you needed my help too.
That day of the year.
I've been now. It's not easy. It's not easy to be daddy.
I can relate.
Okay, let's go ahead. So if you are with me, I'm with you. So to calculate your withholding tax, I'm sorry, minimum tax, it is going to be 0.5% of your turnover. Be careful. 0.5% is not the same thing as 5%. Some of you that you don't know maths. It's not the same thing as this. 5% is this over 100. 0.5% is this over 100. Okay? So under examination condition, don't go and be pressing 0.5 and multiply by the answer. You will miss it. So just take your don't use head to do anything on the exam. Take your calculator, say 0.5 divided by 100. Then you multiply it by whatsoever that you have. Okay? So that is that. Now, what is turnover? According to Finance Act. Okay? Turnover is sales in the ordinary course of business, comma, rent, royalties, interest, dividend, and any other income associated to the business. So that means here your turnover is comprised of so many things. So you are not restricting your turnover to only your sales. Other things encompass in your turnover. Okay? Let me see if I have. Do you have any question? Any question for me? I want to see if I can share the material with you so that we can really do the turnover. Sorry, minimum tax. Hold on, guys. How many of you have my textbook? None of you. I will say this. You have it?
No, I don't. Sorry, sir. How much is it?
Who has it?
Ibuko Olutade.
Ibuko Olutade. Oh yeah, go to the page where we have minimum.
Mercy, I don't have it. No, I don't
Yeah,
have it.
you're whining me.
I have SFM.
So you don't have tax. You're your own.
Okay. Not yet.
Not yet. Okay.
Mercy,
So how much is the textbook?
It's 16,000.
Okay. Do you have PDF?
PDF. Online copy 8,000.
Okay, so if I buy the hard copy, how can I even get it?
Where are you located?
My office will be easier to locate than my house. My office is in VI.
Where are you VI?
Adola Odeku.
Okay. My office is
Okay,
Amarua.
I will chat you, so maybe we can use a dispatch to bring it to my office.
Okay, no problem.
I will chat you. Right.
So I'm trying to look for. Okay, let's see. I'll quickly write the question on the board so that you guys can see. So this will also mean that we have done minimum tax. Before now, in 2000 during COVID, right? So minimum tax rates was reduced to 0.25%. That was during COVID. But after that time, it has been taken back to the normal rates, which is 0.5%. And I also heard that the company is changing minimum tax rates to 15% from this new amendment that they're trying to bring on board. So, yes. So, while I was having a discussion with Adasin Tax, one of the things we discussed was this new amendment that is coming. And unfortunately, they still do not have the base. Okay? There is no base for the computation yet. Okay, let's go.
I was looking for my copy. I have the text.
You have the copy?
Yes, I have it now.
Oh, yeah. Please help us snap it to the class. Is that possible?
Okay. What am I snapping?
Go to minimum page, minimum tax liability chapter, which is chapter 10.
Okay.
That question, illustration 3. Help us snap it to the class. And let's do discussions.
Snap it to WhatsApp.
Illustration 3. Adeola.
No, ABC. Chapter 10. Are you on chapter 10?
Sorry, I was on chapter 9.
Chapter 10.
Can she snap it to the WhatsApp?
Yes, I'll send it now.
Oh, yeah, snap it to the WhatsApp. Let's discuss this.
I've sent it.
Okay, thank you. Oh, yeah, no, married for us.
Okay. The following information was extracted from the statement of profit or loss of ABC Limited. Turnover of 20 million from main business. Profit from discontinued operations, 305,000. Profit from other non-core operating activities, 500,000. Rent received, gross, 1 million. Dividend received from XYZ Limited, gross, 2 million. Notes to the accounts further disclose the following information. Revenue from discontinued operation is 3 million, less expenses on discontinued operations of 2.6 million. Revenue from non-core operating activities, 5 million, less expenses of 4.5 million. We are required to compute the minimum tax of the company.
Okay, thank you. Now, when you look at this question properly, one thing that is clear to everyone is that we have said what we are looking at is the turnover. Okay? Is the turnover we are looking at. So for us to get our turnover, our definition is clear. I told you that turnover will be sales in the ordinary course of business. Abby? Sales in the ordinary course of business, and including rent, royalty, interest, dividend, and any other income associated to the business. Remember, I did not tell you that it is profit. I was referring only to sales or income, which could be investment income and other income. Abby? So if you look at that question very well, we are going to focus only on income, not the profit. So let's go. The first one in this place is what? The first income we have there is what?
Turnover, main business activities.
Turnover. Main business. How much?
20 million.
Mm-hmm. Any other income? Any other income now? You guys just keep quiet.
Revenue from discontinued operations.
From discontinued operations.
Revenue.
From discontinued operations.
How much?
Probably 3 million.
Mm-hmm. Any other income?
Revenue from other non-core.
Do we have rent?
Other
Revenue.
non-core activity.
How much?
5 million. 5.
Uh-huh.
Rent.
Rent. How much?
1 million.
Uh-huh.
Then dividend. 2 million.
Total. This is gross turnover. How much?
28. That'll be 31.
31. That's 1 million.
Less front investment income. Some of you will say, why did we include it before? Now you know. Which is dividend.
That's 2 million.
Why do this week as 2 dates straight? Net turnover.
Is to make the to make the answer full smooth.
We know now. Correct guy. So your minimum tax now shall be 0.5% of net turnover. What would that be? That's 145,000. So that is your turnover. Okay. Do you understand? That's your minimum tax. So, any question? Any question?
Questions.
You said? Hello?
Hello, sir.
Any
No
question?
question.
Yes, this rent. Have we not suffered withholding tax on this rent?
But rent is not frank investment income. Do you understand?
Okay.
It's only frank investment income. That's
But in the real sense, how many people pays withholding tax on rent?
in the real sense. Don't worry now.
You people pay withholding tax on rent? I'm just saying.
This new tax law that is coming will expose everybody.
Except that because I cannot willingly go and pay withholding tax on rent. See what happen.
Because you are not the one that will pay it. You will deduct it. You are supposed to deduct.
Okay. Why paying it? I'm supposed to discuss. Okay, now I get it.
So, but if you go ahead and deduct it from the, what is it called? From your landlord, know that you are going to the house. Isn't it?
Yeah.
You are going out of the house. So you get mine. They come on my money.
You will give government.
You want to give government. You want to even expose the landlord. That's what it means. That the landlord is not paying tax. Because ordinarily the income would not have been seen by the tax authority, if not for the fact that you went ahead to declare. You understand what I'm saying? Yeah. So that is that. So when we meet in our next class, by the grace of God, I think enough of theory for now. So we'll start looking. We'll look at least 3 past questions. 3 past questions from, at least we could look at like 4, but I think next class will be at the end of this complex income tax. At least we'll look at 2024, that is May and November diet. We'll also look at 2023, either November or May, depending. So, or let's target this 4. That is the 4 that we're going to revise when we come in our next class. Okay? So, good day to you. Do you have any question for me? In the absence of none, we'll see you again next week.